All right. I think I'm live now, so I'm going to start talking. I'm waiting for my Facebook to load over here. It looks like we're good to go. Looks like I'm live on the other screen. Okay, so we're good. Well, hello, good morning, and welcome to my short little video, just live and jive, right? I'm just going to live and jive with you guys today and talk a little bit about, I don't want to say secrets, but maybe they're secrets. It seems like they're not a secret anymore. It seems like the cat is out of the bag. I was talking to some people yesterday that are thinking of coming on to our firm, and I'm like, it's really interesting. I've been doing this for a long time, but it seems like more and more as we move forward, more and more people already know about it before we even talk to them. And I think that's awesome. I think that we live in a day and age that, the movers and shakers of the world, right? Literally, right? The ones that shake the world and make things change in our economy. The secrets that they've used are no longer secrets. And so normal folk like you and me, we get to use these concepts and philosophies to better ourselves financially, to create generational wealth, and to live with a new mindset. So I'm going to talk about your financial house today, and I'm going to share just, I'm probably going to go kind of long in this video, but I'm going to share just certain pieces of the message, certain pieces of the philosophy, little secrets, right? And then I'll make some follow-up videos where I'll dive deeper into each little section. But my goal for you all that are watching this video is that it intrigues you. It makes you think, man, I've never thought of it that way. Or, I heard my grandfather say the same things. Or my great-grandfather lived exactly the way Gaines is talking about, but I didn't really understand it, or I didn't know how to do it. And so, in return, we hope that you reach out to somebody at our firm and sit down with them and let them look at your situation and see if these philosophies are in tune with how you want to live your life financially. So with that said, if we think about a house, and we relate it to your financial situation, we would all agree that if you're building a house, the first thing that is really important once you start physically building the house is a good slab, a good foundation, right? The foundation of that house is super important, because if it breaks or cracks or falls down below, falls down, the whole house can come crumbling down. And so traditionally, what a lot of people over in our when I say traditionally in our modern world have assumed that our foundation needs to be our savings, right? Our savings account, the money that we have in the bank, the money that, we know we're not going to lose any money with it. I can access it. I may not be getting any return on it if it's in the bank, but it's a good foundation so that if I have an emergency, I've got access to that. And then on top of that foundation, we're going to build some pillars, and we're going to frame out the house, and at the very top, we're going to have a peak at the top of the house, and that's the riskiest part of our home, right? If we're standing up on the peak, it's a little riskier than standing down on the foundation of the house. So when we look at the foundation, we're going to talk about using a wealth accumulation account as your financial foundation. And what is a wealth accumulation account? I'm going to touch on it a little bit today. I'm going to talk about how people use it. But I'm not going to dive too deep into it. Again, that will be for another video. But let's say that you have created a foundation of safe money for your family. And I think that everybody would agree, all the talking heads of the world, the financial talking heads, even guys and ladies that I may or may not agree with everything they teach, we would all agree that you should have a foundation. You should have a place that, you have your safe money that you can always get to. Super important. Now, people that teach investing starting with the peak of the house, right? The small caps mutual funds and the stocks that you can go buy and maybe hit it big, you might as well call that the casino, right? And the people that lead with teaching you those concepts, hey, I got a hot stock tip, or I'm going to move your money from this mutual fund to that mutual fund. I would be very weary if they haven't evaluated the foundation of your financial house first. So once you create this foundation, wealth accumulation account, savings account at the bank, an infinite banking concept, life insurance policy, whatever you want to call it, once you have created that, you now have a place that you can access money. So we're going to talk about some things that people often purchase now. And I'm going to go back to the wealth accumulation account in a little bit, and it's going to all come together. You're going to understand why I led with the foundation and why I'm now going to talk about borrowing money, things that people normally borrow money for, big purchases like a new car, right? Most people, some people would pay cash for a car, some people would borrow money for a car, most people borrow money. Going on vacation, most people put it on their credit card, and then maybe they pay it off over a year's time, and then they go on their next vacation, so they're paying a high interest rate. Of course, they're paying that debt on the loan on their credit card, but ultimately they're still paying some good interest. A mortgage, right? Buying a house, most people don't pay cash for their house. They take a loan out on that house, and that's the normal way that most people do things, and that's totally understandable. So let's talk about one of the most common things that people take loans on, and that would be a car, right? So let's say I want to buy a new car today. If I want to buy a new car, unfortunately, most cars you're going to fork out about $50,000 for most cars these days. And so I have a few ways that I can purchase this car. Okay. Number one, I could pull money out of my savings account at the bank. So if I have $50,000 built up in my foundation, okay, that's a good number for some people, might need to be more, could be less for others, but let's say the foundation of my financial house has $50,000 that I can always access when I need to. And I want to go buy a new car. Well, I have a few different ways that I can buy that car. I can pull my $50,000 out of my foundation, out of my savings account at the bank, and I can pay cash for that car. So here's the cool part about doing that. I now do not have a car payment. I have a paid for 50. Oh, wait, it's not 50,000. It's 49. Oh, wait, it's 40. It's a $45,000 car. A year goes by, it's a 40. Yeah, I've got a paid for car, but it's a depreciating asset. And guess what? My $50,000 is no longer in my savings at the bank, so it's not growing. Now, granted, no money is really growing in a savings account at the bank, and whatever it is growing by is taxable. But at the end of the day, I've now taken my $50,000 foundation and I've thrown it into a depreciating asset that is going down in value every minute. Okay, but some would argue that, never take out a loan, right? Just always pay cash for everything. And I'm never going to argue that with somebody. I will challenge people, and I will say, if you look at the math, if we do an Excel spreadsheet and we look at the math, it doesn't always make sense to pay cash for things and give up that cash in another vehicle. Now, I understand a lot of people look at this as, maybe because of their faith and something that they've read in Proverbs, where in Proverbs it says the borrower is slave to the lender. And I don't disagree with that. I don't disagree with anything that the good word says, okay? But I also don't see anything in the Bible that says, and maybe I'm wrong, check me if I'm wrong, but I haven't found anything that says, taking out a loan is a sin and you're going to hell if you take out a loan. I haven't seen that. So sure, if I take out a loan from somebody and I am obligated to them and I have to pay them back all the time, and they can take my thing that I use the loan to buy with at any moment from me, yeah, it kind of makes me a slave. So I get it, and I agree with that sentiment. But mathematically, there are other ways to look at this. So when we look at buying that car and we liquidate our savings account, we pay cash for that car, cool, again, we don't have a car payment, so There's a little more cash flow in our household. That's good. Cash flow is king, right? I corrected one of our agents jokingly, lovingly the other day when he said, is cash or cash flow king? And I said, well, Jesus is king, but hey, that's all right. The sentiment is there. Cash flow is very, very important. I would say cash flow is more important than cash, just a lump sum of cash. So cool, you got a paid for car. The other way that you could purchase that car in the traditional sense, right, in the normal way, is you could go to that same financial institution. So you've got your $50,000 in the typical financial institution of a bank, and instead of pulling your money out of there, you can go to that bank and you can say, you know what, I would like a loan for a car. I want to buy this new Dodge Ram truck. It's really cool. I can't wait. I'm gonna look so good in this car driving around. And I don't want to liquidate my $50,000 savings. I want to leave that there in case I need it. So can I have a loan for $50,000? I mean, you got my $50,000. So can I just get my $50,000 back, but as a loan from you guys? And the banker's going to say, sure, Mr. Duvall, you can have a loan, but I need you to fill out this application. And okay, so you fill out this application. Actually, we'd be typing it these days, right? No handwriting anymore. I don't even know how to sign my name anymore because I type everything. But we'd fill out an application online, and we're gonna share with them every single aspect of our financial life. Our, everything about our background, every penny we have everywhere, our social, our dates of birth, everything. We're just giving it to this banker, and the banker is then going to run a credit report with that application. And because of maybe something you just forgot about back in the day, the banker's going to come to you and he's going to say, we got you approved, man. We got you approved for a 72-month loan on that $50,000 vehicle, and we got you an interest rate of only 6%. Only 6%? Wait a second. My $50,000 is with you, and I'm lucky if I'm getting 1%. But I want $50,000 back from you, and you're going to charge me 6%? And my car is collateral for that $50,000. So you're going to tell me my interest rate. You're going to tell me how much I have to pay every single month, how many months I have to pay that. You're going to require that I have to have insurance on it. Now, insurance on your car is good, but I hate when people require things from us, right? So you're going to require that I do that. And I have to put you on the insurance as somebody who also owns this car and has an interest in it because you have a lien on it. And if I don't make those car payments, you're going to take my car from me. That's how most people buy vehicles. So there is a third way to buy a vehicle if you have a wealth accumulation account created. So if you have built up your wealth accumulation account, instead of stuffing all your money in a savings account at the bank that gets no interest, and if it does get any interest, it's taxable each year. And if you want any money back, they're going to give you some money, maybe if your credit's okay. If credit's bad, you're not even going to be able to get any money from that collateral that you have in there. And they're going to determine what they're going to charge you. But if you have your wealth accumulation built up, your wealth accumulation account would be held with a life insurance company, okay? Life insurance companies that have been around for hundreds of years, that have paid dividends every single year in and out. In the Great Depression, dividends, your money went up. During the 2008 financial crisis, dividends, cash value went up. During the 2020 thing we're still going through, continued growth in your accounts, okay? So if you have built up that same $50,000 inside of your wealth accumulation account, you now can become your own banker. So you can do the same thing that you could have done at the bank. You could say, hey, life insurance company, I'd like to withdraw my $50,000 and pay cash for that car. Now, while you can do that, and that's important for people to know, you can actually withdraw your money out of your cash value, okay, from your wealth accumulation account, and you can use it to pay cash for things. But there's another way that you can access money. Instead of getting a loan from the bank and filling out a credit application, them running your credit report, them making all these decisions for you, you can just call up the life insurance company and say, hey, you've got $50,000 of my money in my wealth accumulation account, and I would like a $50,000 loan. And that loan is sent to you instantly from that life insurance company. You may have to fill out a little sheet just to request the money, or some companies you can just type it in online that you just want your money, but there's no credit report ran. There's no looking at any of your other finances. They are simply going to use your $50,000 that is cash value in your wealth accumulation account. We're going to go back to in a minute what's happening with that cash value, and they're going to send you a check or wire money into your account in the form of a loan. Now, that loan is at a predetermined interest rate, probably around 4% if the bank is going to charge you 6%. So already it's a lower interest rate. Now, your car is not collateral for that loan. Your $50,000 of cash value is, and your death benefit. So if you were to die before you had paid back that loan, it would just be taken out of the life insurance death benefit that your family would receive. So now you've got a $50,000 loan at a reasonable interest rate, but check this out. You're in charge of how you pay that back. So you could take that same payment that you would have been paying to a bank if you had taken out a normal car loan, let's say it's $600, and you could be paying $600 back towards the $50,000 loan. And then it's Christmas time and little Johnny wants a new hoverboard. And if little Johnny wants a new hoverboard, he's going to get his hoverboard, right? And so maybe hoverboards, like everything else, are way more expensive now. And gosh, I've got to either make my car payment of $600, or I'm going to get little Johnny a hoverboard for Christmas. Well, if you took a loan out from the bank, you better make that car payment. They don't care that little Johnny wants a hoverboard. But if you took a loan from the life insurance company, you can skip a month. You could skip 6 months. You could take a year off before you make any payments back. You could lower your payments back from $600 to $200 for a few months. You could increase it to $1,000 a month. You are your own banker. You're in control of that payback schedule. And guess what? We haven't even talked about it yet. Your $50,000 over here, it's still in your account. So it is still growing. So if you were to take a loan from the bank at 6%, sure, your $50,000 is still in the savings account at the bank, but it's maybe getting 1% and it's taxable if you're lucky. Well, in the cash value inside of your wealth accumulation account, your $50,000 is growing compound interest on top of itself. If we look at historical numbers, anywhere from 3 to 5%, maybe even 6%, but let's just use 4% right now. It's growing compound interest 4% year in and year out. So it's not 4%, $2,000, 4% of 50,000. It's not growing by $2,000 each year. It's growing by $2,000 in the first year, because that's 4% on 50,000. Then it's going to grow by more because you're going to get 4% on 52,000. And then you're going to get 4% on 52,400 and whatever, right? So that's compound interest. Albert Einstein said one of the greatest wonders of this world, right? Compound interest. So your money is growing at a very reasonable return, compound interest on top of itself, and tax-free, completely hands-off from the IRS. I know we all love the IRS, and I know we love giving them money, but isn't it kind of cool when we have a vehicle that is growing tax-free, 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 and they can never touch it, right? So here you are, you've got a $50,000 loan, you're paying down that loan. So you have an interest rate on it. Maybe it's 4%, but it's 4% on 50,000 in year one. But after you've made some payments, maybe it's 4% in year two, 4% on 46,000. And then over here, your 50,000 is continuing to grow, grow, grow. Now, for another video, I'll do the math on that situation. But if we take that situation and compare it to the way most people buy cars, at the end of the 72 months, you're going to come out thousands of dollars ahead if you had a wealth accumulation account that you used for leverage and you were in control. Now, the compound interest is awesome. The tax-free growth is awesome. The absolutely zero risk when stuff goes down in value, this never goes down. That's all awesome. But the most important thing I hope you heard here in this scenario that I just talked about was that you are in control. You're in control of when you want your money, how much of your money you want, and you already know the interest rate because it's fixed. You can do a variable interest rate, but you know the fixed interest rate going into this. The day you start your wealth accumulation account, that fixed interest rate is locked in and can never change. And you're in control of the payback schedule. Pay it back fast, pay it back slow. Don't pay it back. You're in control of that. Now, this same principle applies to much bigger things. In the title of this video, I talked about what do the wealthiest individuals in the world do? Well, the wealthiest individuals in the world don't get wealthy by how they buy their cars. Now, they probably use these concepts, okay? But you can use it for everything you would normally finance. Again, I mentioned earlier, hey, I want to go on vacation. It's going to cost me $10,000, take my family on a week-long vacation to Maui. So I can swipe my credit card for 24% interest and pay it down over the next year and then go on another vacation. Or I've got my $50,000 wealth accumulation account. I can say, hey, I want a $10,000 loan. Send me $10,000. $10,000 is deposited into my bank account at a 4% interest rate. I can make the payments back the same that I would have to the credit card, but I'm going to pay it off much quicker because the interest is lower. And my $10,000 over here continued to grow, tax-free, compound interest, hands off from the IRS. In most states, also hands off from bankruptcies. In most states, also hands off from lawsuits. I mean, this is the most cherished vehicle out there that you can hold your money. Now, some may say, well, I could put my money into mutual funds or stocks and get a better rate of return than that. And you absolutely could. I'm not giving you investment advice. I'm giving you savings advice. We're talking about things where you cannot lose money. So if you can't lose money, we can't compare it to things that you can lose money. They're apples and oranges. Okay. Now, if the apples are the places where I can't lose money, I'm growing apple trees in my backyard all day long. Forget the oranges. I do love grapefruits. I will add that in. So maybe I'll grow some grapefruits in there. But at the end of the day, this is the place that you want to house all your money. So can you in turn get a better return on that money than even 4, 5, 6%, 3%? Just, grow. Not this, right? Just grow. Can you get even a better return? Absolutely. There's other ways that you can use this to enhance your wealth. So example, I in a previous video mentioned that I recently purchased a home using my wealth accumulation account. So the cost of the home was approximately $500,000. I could have got a loan, but interest rates have gone up really high and it would have been considered an investment property. So they would be even higher. The terms would be even more stringent. And I could have filled out a loan application, paid a bunch of fees, underwriting fees, appraisal fees. I don't know, all those fees, right, that go along with getting mortgage, commissions to the agent, which is great. I love it that my loan officers and real estate agent friends all make commission when they do work. We should. I make commissions when I do work. They should make commissions. But in this scenario, I was able to call up a couple of the life insurance institutions that I have my wealth accumulation accounts with and say, I'd like you to send me $500,000. I didn't have to fill out a credit application. I didn't have to pay all those fees. I just got my money. Then I gave $500,000 cash to the builder. And now I have a $500,000 loan at a 4% interest rate on an investment property. That's pretty darn cool. And I'm in control of that payback schedule, even cooler, right? It keeps getting better. Now, so what am I making on my money? Well, my $500,000 is still growing at 3 to 5% compound interest on top of itself because it's still in my wealth accumulation account. My house that I just bought, if we just look at historical, and I understand sometimes we have dips in real estate. We may be approaching that right now. But if we just look at real estate in general, most good realtors or real estate investors would tell you to expect about 4% return on your real estate over time. So now my $500,000 is growing at 4% compound interest over here. My $500,000 house is growing at 4% compound interest. My $500,000 is still in my wealth accumulation account, growing about 4% compound interest, right? And then I have a $500,000 loan that I'm paying down, and sure, I've got a 4% interest rate on that loan, but after a year, I've got a little less interest rate on that loan because maybe I've made some good payments towards it. Now I only have 4% on $475,000 of that loan. And the next year, I've only got 4% on $450,000 of that loan, right? So that is another example of how you can take your money, have it working for you. Remember, I mentioned earlier, cash flow, right? Cash flow. Get your money moving. Your money moving in always a positive direction is how you can build exponential generational wealth. Now, I left out one of the most important things about this wealth accumulation account. It's inside of a life insurance vehicle. What is life insurance? Life insurance is when you die. Now, in a wealth accumulation account, it's a permanent life insurance policy. So it will be there when you die. So if you die tomorrow, huge death benefit paid out to your family. If you die when you're 90, huge death benefit paid out to your family, tax-free. So this money is inside of a wealth accumulation account. So if you have $50,000 in there inside of a life insurance policy, maybe the death benefit's $500,000. So if you die next year, your family wouldn't just get $50,000, they would get the death benefit of $500,000, 100% tax-free. That would put them in a better financial position, right? And possibly be able to maintain their lifestyle that you have created with your family. Now, let's move on further. Let's say I'm 90 years old and I pass away and I leave a lot. I've built up all this wealth for my family. Well, depending on if I've set it up right with trusts and using my CPA's advice, there may or may not be some taxes. We don't know what tax laws are going to be down the road. But what we do know is that the wealth accumulation account is going to spit out a huge tax-free death benefit to your family. And it's 100% hands off from the IRS if set up right and structured properly. And that's key. There are many people in our world, in my world, that pretend that they know what they're talking about when they talk about the greatest book written on this subject, Becoming Your Own Banker by Nelson Nash. Oh yeah, I understand becoming your own banker. Oh, I understand infinite banking concept. I know what a wealth accumulation account is. Well, you know why I believe that, and I know that most of them don't know what the heck they're talking about, is because we see client after client after client after client that comes to us and their policies were not properly structured. The agent structured it so that they could make more commission versus what is right for the client. So in our firm, we have a kind of a clear-cut client acquisition process, a way that we teach our agents to acquire clients. Now, some of our agents go and do it differently, and some kind of use hybrids of what we teach. And I don't care, because the number one rule in our firm, the number one rule is that you always do the right thing and stay ethical. So we don't focus on what will make us the most commission. We focus on what is the right thing for our client. What is the ethical thing to share with our client? What is the right way to do it? You know, as many have said throughout the years, there's never a wrong time to do the right thing. So therefore, always do the right thing. So it's very important, if you are intrigued by this concept, that you meet with somebody who truly understands it and truly knows this and has been mentored by somebody who has done this for years. Super, super important. But let's go back to the wealthiest individuals. Now, we talked about the foundation, right? Now, does that mean that every single dollar you own should be in that wealth accumulation account? No, that's not what I'm saying. But that becomes the foundation of where your money goes before it goes elsewhere. So you might have multiple buckets. Most of our clients have multiple buckets. So they have their wealth accumulation account. Okay, they have this bucket that's built up, and some have 50,000, some have 5,000, some have $5 million in their wealth accumulation accounts. And then they might have another bucket that's a similar product, but even though it's often sold incorrectly as having no risk, it does have risk, but it has a much higher upside potential. Okay, so maybe some have some money in there too. And then maybe some have money in their Roth IRA. Awesome place to house money. That's money that you've already paid taxes on. You've now stuffed into a IRS vehicle, and you've chosen your investments inside of there. But as long as you don't touch that money before 59 and a half, all of the money you put in and all of your growth is 100% tax-free. That's a good bucket. We like those buckets. We help our clients set up Roth IRAs all the time. Now, we use vehicles that don't do this. So inside of your Roth, did you know that you can have a Roth that in a bad year has a 0% floor? So when the market goes up, you get some good growth from that. Maybe not all of it, but some good growth from it. But when the market goes down, your money stays flat. So you can do that inside of a Roth, and we help our clients with that. And then you have this other bucket over here called a 401k, or maybe an IRA, a traditional IRA. But the 401k, you have at work, you put money in, your work matches some of that money, great. You should be putting in as much, unlike some of the other financial talking heads that tell you it doesn't matter if there's a match. I completely disagree with that, but I don't argue that with our clients. Let's look at the math, right? Math. So the big word, the big buzzword the last couple of years was the science, right? Well, in our world, it's the math. You know, you can put me on the biggest television show on finances and put me next to somebody else who disagrees with what we teach, and I'm not even going to argue it with them. I'm just going to say, let's do some math. Let's pull out a spreadsheet. Let's look at your ways, your philosophies, what you're teaching these people, and let's look at the ways that we believe that members of our firm are teaching our clients. And it's simple math. At the end of the day, the math doesn't lie. So if the math says if you have a 401k at work and they're matching that, right, you should be putting in as much as the match. If you put in 3% and they put in 3%, put in 3%. Now, I might encourage you to take your 3% and put it inside of the Roth 401k at your work, right? That might be a smart thing to do because that bucket will be tax-free when you retire. And then you have this taxable bucket that your employer has contributed to. So there's lots of little things like that, but understand you might have a wealth accumulation account using a properly structured life insurance policy. You might have what is called an indexed universal life, which does have risk. And if you talk to an agent that says there's no risk in an IUL, run and come talk to me. I will show you all day long that there is risk. I love them. There's huge upside potential. But all these guys out there marketing, there's no risk, there's no risk, there's no risk. They're not being truthful. Now, most of them just haven't been told the truth themselves. So I don't want to say that they're lying, but that's not truthful. So you might have a wealth accumulation account. You might have some money in an IUL. You might have some money in a Roth IRA. You might have some money in a 401k split up between a Roth 401k and a traditional 401k. And now you've got a well-built house, okay? So if you get that call from your doctor friend that shouldn't be calling you and telling you should buy this stock, and he says, hey, I got this stock tip, there's this new pharmaceutical, and you should buy it, and you decide you want to buy it, cool, go for it, go gamble, go to the casino. That's on you. You've got an incredible foundation in your wealth accumulation account. Your money's not going anywhere there. You've got this other bucket, this bucket, and this bucket, and you're good. So if you want to go take a little risk, go take a little risk, but get all of this set up and structured properly and go moving for you. Get your money moving. Now, when that doctor calls you, you might be like, no, my risk is me. I work really hard. I make a lot of money. And so I'm not going to take risk in a speculative investment. I've got my well-built foundation here. I've got some risk in my Roth. I've got some risk in my 401k. I'm going to take my risk or my money that I've risked myself for and worked hard for. I'm going to keep that money safe, and I'm going to go get some real estate. I'm going to get some cash flow real estate. I'm going to go buy a $500,000 investment property where my $500,000 investment property is growing. My $500,000 is still in my wealth accumulation account and it's growing, right? And now I've got somebody paying me rent of $3,000, $4,000 a month on that house. That's going right back to the loan that I took out. I hope you can see the big picture. You can build absolute wealth still being conservative financially. I had a couple discussions lately, and the name Warren Buffett came up, and somebody said, I heard Warren Buffett's buying a bunch of this stock or buying a bunch of that stock. Cool. But usually guys like Warren Buffett still have 90 to 95% of all their wealth in safe areas. So it might sound like, oh my gosh, he bought millions of dollars in that stock. That might only be 1% of his wealth. So do you have 20%, 80%, 60%, 95%? What percent of your money is safe? And do you feel okay then taking some risk with the rest of your money? I hope you see the big picture here. I hope this has been helpful. I appreciate you all listening. I'm going to go back and see if there were any questions in the comments. And man, I love talking about all this. And I hope you all stay blessed. Take care.